This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Jeff back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jeff's picture saying looking for the downloads. Now, Eric, let's start with crude oil.
I don't have any EIA inventory data this week because we produced the show a day early for the holiday. The overall story is the same as last week. There's plenty of room for more weakness in energy prices on macro fundamentals, but there's also plenty of room for a dramatic spike higher if the geopolitical situation escalates further. I'm flat and I don't see any appealing directional trades from this entry point.
Well, Eric, on page 2, I have that chart of crude oil, and the situation really hasn't changed over the last few weeks. We're in a primary downtrend, trading well below the 50-day moving average and failing continuously to beat it. Almost every rally is met with some degree of selling, but we have, over the last 3 months, established a support line that has been tested numerous times, even going back to 2023. So the big question here, does that support line act as a base and a floor for crude? The primary downtrend could still theoretically create a short-term distribution cycle that could go down to the low 60s and just wash out any hopeful traders and or drive a new wave of short selling. But generally, I think that this is where there is a fair value zone for oil that could be where we see the stronger and longer term base establish itself, even if there was a short-term dip down to, let's say, $62. Overall, there is no new bull trend yet, and there's no new accumulation cycle that has started. So we have to respect the prevailing downtrend as the dominant one while it trades along this key support. Now let's move on to the equity markets. What are your thoughts here?
Markets are still digesting the Trump win and cabinet picks, but it's starting to look like a sustained rally higher may be starting. Still early to tell, though. The jury's out. Let's keep an eye on it.
Well, Eric, on page 3, I have the S&P 500 chart, and the markets here continue to demonstrate accumulation, higher highs, higher lows. Every dip is being bought. So the prevailing uptrend is intact. And there's numerous measurements that showed 6,200 as a reasonable target for the short term. So assuming that the market will continue this into the jobs number will be probably the path of least resistance. The bigger question, of course, will something like the jobs numbers, which is next Friday, be a catalyst to cool off a market that's been pretty hot and persistent up until now. The breadth of the market really at this stage has somewhat widened. We continue to see the equal weight index doing incredibly well for the S&P, and sectors like the financials and consumer discretionaries and energy stocks have actually all done incredibly well, widening that breadth, but the Mag 7s have not participated. And the interesting thing is, if the market was destined to make a move to 64 or 6,500, it would almost certainly need the additional benefit of the Mag 7s breaking out. And so I think that is going to be a really important thing to watch in the next coming weeks, is will this trade range for many of these Mag 7s break bullishly to the upside, or then we have to curtail our enthusiasm of how far the market can go. There's clearly no sign of a reversal yet, and it will likely need a catalyst. And at this point, it's clear that the jobs numbers and maybe the FOMC meeting that is coming up in a few weeks could be the only real catalyst this year on the short term beyond some big geopolitical event. Nonetheless, let's move on to the dollar. What are your thoughts here?
The Dixie put in an impressive shooting star on Friday, testing 108 and maybe putting in at least a short-term top. So are we turning down here, or are we just catching our breath before moving higher? Probably too early to tell.
Yeah, Eric, certainly did have a big burst out to the 108 level, which is certainly a breakout out of a 2-year trade range. But I think it's more important for us to look a little bit under the hood on some of the cross currencies to better understand the potential of a US dollar move. I mean, I want us to look on page 5 on our chart of the Euro USD on a weekly chart. So we're really going out and looking at the last half decade on the charts. And you can see that 2-year trade range on the euro that was more or less defined between 105 to 112. And we now have definitively broken below that trade range. Now, has this now started a new downtrend? Will we see parity or even 95 cents on the downside of the euro? At this point, technically, there is a break, and certainly that window is now open. The question is it on the short term oversold where we may spend the next few weeks, so let's say, bouncing back to 106, 107 on the upside just to relief rally from a very oversold move. But generally, I think that this is a chart that is highly vulnerable for a continuation pattern to the downside, and certainly no reason why we can't go back to 2022 levels that on that euro. So on page 6, I have that US dollar CAD, and the Canadian dollar has just been incredibly weak. Now, there's again was this 2-year trade range, this almost like ascending triangle pattern consolidation where all the highs around that 138 level on the upside, 139 were major resistance levels. We now have definitively broken out and have spent even weeks trading above this level. This is the Canadian market continues to be weak, and the currency is reflecting that. And so we have a scenario now where the highs from 2020 up along 143, 144 are the only real next resistance level for where this currency can go. And then on page 7, I have the US dollar against the Mexican peso. And what we can observe here was that there was a very clear US dollar downtrend that lasted several years. And we have a definitive trend shift that happened in the middle of the year, and we're now back into the important trade ranges that were established back in 2021 and 22. The bottom line is that there is a lot of these types of currency situations where the U.S. dollar can do very well. You know, maybe the U.S. dollar yen might be able to buck the trend, but beyond that, it does still make a case that the U.S. dollar has potential on that dollar index to head higher. And maybe we're going to go back and retest some of those levels in the 110, 112 area on the Dixie. Nonetheless, let's move on. What are your thoughts here on gold?
Well, it's crystal clear that the cause of the big sell-off on Sunday night into Monday morning and then all day on Monday was rumors of the now official ceasefire between Israel and Hezbollah. But the market completely ignored the simultaneous news that the Biden administration has discussed giving nuclear weapons to Ukraine. Just imagine if Russia was giving nuclear weapons to the Mexican drug cartels. Dmitry Medvedev's rhetoric couldn't possibly have been stronger, warning that the very discussion of such a scenario is considered by Russia to mean that the U.S. is preparing to go to war with Russia, and actually giving such weapons to Ukraine would be considered an act of nuclear aggression against Russia that would be met with a nuclear response. Yet gold traded down on the news. What that says to me, Patrick, is that the U.S. market isn't really taking this nuclear escalation risk seriously. I note that both Sunday night into Monday, then Monday night into Tuesday, we saw the same pattern where the market sold off kind of gently during the Asian session. Then Europe bought the dip. I think people in Europe are much more presently aware of the risk of a nuclear escalation and what it could mean to their safety. They were buying the dip with that awareness. As soon as U.S. markets opened, they were selling gold hard, suggesting that in the absence of objective news media in the United States, maybe traders aren't really taking to heart the seriousness of the geopolitical escalation that's going on between the United States and Russia.
Well, Eric, there's no shortage of geopolitical headlines that certainly can be drivers for gold, but I'm keeping it simple by looking at the technicals. And we had a very bullish advance since the summer that saw those highs near 2,800 come in. Since then, Gold has, over the last month, been in a mean reverting correction. To me, this is just a typical correction in a primary bull market. Could we go as low as 2,500? Absolutely. But generally, this consolidation should be bought. The primary trend will resume. What I'm looking for is a confirmation of a legitimate price action back above 2,700 to suggest that maybe the next leg of a bull advance has begun. But realistically, there's an entire possibility that we're going to be waiting until January for this gold consolidation to finish before we resume bullishly on the upside. Now, Eric, let's touch on uranium. What are your thoughts here?
Well, the uranium sector continues to perform very well in the speculative issues, but the spot price of uranium is still stagnant. And the big rally, the really big rally that we've been waiting for, can't begin until the spot price starts to move. Meanwhile, the trend is still up, but the RSI and slow stochastics on many of my charts are high and wavering, suggesting that a swing trade lower to catch the market's breath may already be in play.
Eric, technically uranium's been in a consolidation all year, and we were obviously seeing an extended basing formation because ever since basically the middle of the summer, uranium stopped going down. It just hasn't started going up. And so at some juncture, there probably will be a technical catalyst to drive a bullish breakout on spot prices, but it still has just not come around. At some point when that happens, we'll technically observe it and look for that next bull trend to really get going. But right now, I consider this to be trade range bound, even though uranium equities continue to do actually very well. The spot prices of uranium simply are not confirming yet, but they will inevitably. Finally, on page 10, though, Eric, I wanted to just have a quick peek at copper. And copper prices continue to trade along year lows. More importantly, the window at this point is still open to even consolidate another 25 cents lower back into trade ranges established in 2023 and early 2024. Irrespective, we are now in the midst of a 6+ month correction in copper that is getting mature. I think even if there is another 25 cent downside, it generally is, we're much closer to where the bottoms are likely to be established. The bigger question is, when do we transition from this kind of distribution cycle and begin a new bull cycle? And that clearly is not evident yet. We'll be watching for those signs, but right now, the rest of the year may actually still see some short-term technical weakness, but in the bigger picture, I think those are all big buying opportunities.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Seresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.